What is the word, y'all? Welcome back to the Y3 podcast. We got my man, the Lucrative Investor, back on here. Welcome back. We had a show last time on our YouTube, and we had a few questions. We actually ran a Q&A all week long, and then we had a few questions on the video itself. So we decided that we was like, all right, we got to come back on here. We did even talk about on the show doing a break-off segment where we are kind of educating people on the stock market and how to invest and what to invest in. But that being said, we're gonna dive right in. I got a bunch of questions from viewers, from people that on our Q&A that we ran all week. We ran it on your platform, on my platform, and we had some questions on the actual episode itself. But anyway, what's the word, bro? How you doing? How you feeling?
I'm alright, man. I just, got done finished Christmas shopping for my daughter.
Word.
This is a hard time of year, man.
I hate Christmas.
I hate Christmas too.
I fucking hate Christmas.
And these toys nowadays, they blow my mind. You got $40 for a doll. I remember everything was so cheap back in the day, bro. I used to get Hot Wheels for $1. I was satisfied. Nowadays, these kids want iPads and shit.
Oh yeah, my nieces asked for some fucking doll. That's just like, it was like $300. It's like a real life doll, some shit like that. I'm like, what?
It didn't look
bro?
like it was going to the club. It was
I don't know, but when she seen it, cause she already got it, she got it early. But
okay.
when she seen it, she was like, this has a mom body, cause it's thick.
Bro, it's probably one of those LOL dolls.
Yeah, I think so, it is, bro.
Terrible product. They make a lot of money though. They definitely make. I don't know.
She has a mom bod.
Shit, I gotta see who.
This
who
doll
makes
thick.
That.
I'm like, yo, what the fuck?
They're ridiculous, man.
But yeah, man, I'm not a fan of Christmas. I mean, we all was a fan of Christmas as kids. Maybe not, at least.
Yeah, getting that PS2.
Right. But
that was about it.
But now it's like, now that we're the gifter.
For real.
That's it.
Bro, I was staring at some toys today for about 30 minutes. I didn't know what to pick. I'm like, why?
No bullshit. Every time I go to the store, like I always take a stroll down the toy aisle just because whatever. I have a kid, so even if I'm at the store to pick up some shirt, fucking clothes at Target, whatever. I go to Target, pick up the groceries, whatever. Yeah. I'll take a stroll down the toy aisle just to see what the fuck's there. I be seeing the weirdest shit for like $40, $50. I'm like, bro.
And it's the same stuff every year. I said I bought this stuff last year.
Yeah. Yeah.
It's crazy. It's crazy.
And then they asking for it again.
I'm like, you threw this stuff in the trash.
Right.
Last year.
But we're gonna dive right into these questions. So we're gonna get. This seems like the most simplest one to get started with. And I had some. Maybe we didn't cover it in the first episode, but the person asked, how do I get started? How do I get started in stocks? Just elaborate on that. I mean, obviously there's millions of ways to get started, but
there's a million ways to get started, but just be curious, like curiosity. In the first episode, I said do your homework. Learn vocabulary. Just get comfortable with the idea of putting your money away and not touching it. You have to create that habit first of all. But just understand your risk, understand your benefits, and understand your goals, and that's real important. So just getting started, I would just say, sit down, come up with a game plan. You have to take in consideration how long do you want to invest for, because everyone has different goals in life. You might want to buy a car 5 years down the road, or a house, or put your child through college. So find your comfort zone of a time period, how long you want to invest, how much you want to invest, and all this goes into a strategy in one.
There's how many different types? There's investing, there's trading, there's
See, that's the thing. I don't call traders investors. Investing is like putting your money somewhere and looking for a return.
So what makes you an investor? What
you know,
makes
long term.
Okay.
You know, if you're going long term, that's a, you know, true investor. You know.
So, but if your goal is quick, short money, it's
You're
would
more
say
of a trader.
you'd be a trader.
You know, I don't have anything against traders. You know, but you know, it's more of a gamble, so to speak.
Yeah.
You know, and it's not, to me. It's just not a tax savvy thing to do.
Being a trader.
Yeah, trading.
Because I seen that you posted. So now that leads me to another question because it just hit my head. But I seen you post when you posted on your Facebook the other day, the IPO of Airbnb. It was like whatever the fuck it was, $68, I think.
Yeah.
And like 3 hours later, it was $148.
Yeah, that's
so
skyrocketed.
that's a situation for a trader to get into.
That's a trading move because, you know, although Airbnb, right, they prove to have a solid business model. I don't know if anyone's been paying attention to them, but they're excellent. They have a solid business model because a lot of people was doubting them through the pandemic that they was just going to fall apart. That did not happen.
And it makes sense to think they would.
You know,
yeah, I mean, it makes sense to think they would because, like, oh, Corona, I'm not staying in no one's home. But and even the hotel shut down for a few.
See, now the hotel's more crowded. Like an Airbnb, like you could be out in a cabin somewhere.
Right,
you know what I mean?
Right. That makes sense.
So they still generate. They lost a lot of money actually, but yeah, that situation's more for a trader because I don't see me personally holding anything like Airbnb long term right now because it's just too early. What my personal strategy, I was going to let them let the price of their stock correct itself. And then I was going to probably see where it was going to go from there. But other than that, you know, I stick to what I know. So, and that's another thing. You definitely want to put your money into things that you're certain about. You know, that's one thing that Warren Buffett. I reference Warren Buffett a lot, but that's one thing that he stresses about. You know, he's not going to invest his money into a company that he doesn't know about. You know, not saying that like Airbnb has a easy.
So at no point should you be putting your money into a company before you research their history, their business model, and such as that. But is that even available to the public? Their business models and stuff like that?
Definitely. You know, when you're a part of it, when you hold a stock, you definitely get like updates from management and things like that. And that's another thing. You want to pay attention to their leadership. Like pay attention who's the CEO. Look at their background. Look how many businesses that they ran through, failed. Look at their failures, successes. Look at all of that because that leadership is everything. You know, if you don't have a good leader, you don't have a good company.
All right, word. You know? So when I'm looking in, you just named a few, but like I don't know if that was everything, but like when I'm looking to invest into a company today, when I'm searching up, what are some things I want to search up to know? What are some things I want to know about a specific company before I buy a share?
First thing that I do is that I just look at I look at the problems that they solve. If they have a product or a service that solves a problem, that's a plus. But then you have to look at things like their balance sheet. You know, like how much debt do they have? How many liabilities? How much cash? Like what's their operating income? Things like that. You want to look at their price to earnings ratio, things like that, because that tells you their actual market value. You know, that's a little bit more fundamental than than normal stuff. It's a little bit more complicated, but you know that takes time to get into with the equations and ratios and stuff like that. But definitely those are things that you want to pay attention to.
Right. So moving on to the next one. Why should I invest in stocks instead of putting my money into a certificate of deposit? And before we even get into that question, what is a certificate of deposit?
A certificate of deposit is, they're called CDs, but long their certificate of deposit, it's like a savings account. But this is the thing, it's less risky, you know, you're guaranteed a return, but since it's, you know, the less risk an investment is, the less return you're going to get.
Right, okay.
And that's why I'll go with the stock market because I know I can outperform a CD. Because over long term, just in general, history shows that stocks outperform CDs over time. You know, you'll get like around 3.7%. But I'm saying the S&P 500, more than 75 years history, track record, 10%.
Right.
Average. You know what I mean?
Doesn't even touch a CD. CD doesn't even touch that.
Yeah, CD doesn't even touch that. Not a bank. Not, real estate is up there. That's not. There's tons of ways to get that 10%. Stock market to me is just, a little bit more easy.
And when you talk about the stock market, people hear the term stock market and just think like, and the average person, I feel like they just think, oh, one thing, or oh, Wall Street, or you know what I mean. Yeah. But there's multiple different ones we was talking about before. Like there was like NASDAQ. There's
the exchanges. Yeah,
that's what they call exchanges.
Yeah, okay. You have the NASDAQ. You have the NASDAQ. You have the S&P 500 with 500 top companies in America. There's different exchanges that you want to get into, but the one that gets you the average of 10% is the S&P 500, which Tesla, I believe, was just added to the S&P 500. Right. So that's a actual big thing.
So you say all day stock market over over CDs?
It just depends on what type of it depends on your goal. So if you have more of a short-term goal, and you want a little bit more passive investment, a little bit more less risky, a lot more less risky, a CD is a good way to go. But if your goal is a little bit a little bit bigger than that, a little short-term, and you're thinking long-term, longevity, you want to definitely go with the stock market. You'll get way more returns, bigger returns. It's more risky, but life is a roller coaster. So just stay the course. Right. Stay the course. Don't let human emotion get in the way of like your actions in selling. We'll get into it. Why I don't believe in selling stocks. Taking profit. We'll get into that later.
Okay, cool. So next question I had, this was actually a direct question on the video we had, is that because we was talking about, I remember we had brought up a story, we was outside having a conversation with someone, and he was talking about how he put all his money that he planned to invest with into McDonald's, and he lost a little bit, and then he like immediately pulled it out, and then we talked about diversifying your portfolio and stuff like that. Yeah. So this was a question that we had following that segment, and it was, is there such thing as an over-diversification?
There's such thing as over-diversification. That's like a first-time investor mistake. It's not really a mistake. It's just something people do when they really don't know what they're doing, but they know what diversification is.
Right. Like, I'm like, here.
They're all over the place. They just want to be certain, like, I don't want to lose money, so I'm going to make sure my money's spread it out. But, you'll end up not losing a lot, but you won't gain a lot neither. It's, you'll be going at an extremely slow,
just very baseline,
pace,
yeah.
And that's not where you want to go, especially if you want to.
If that's retire. The case, then
like, you might as well just put your money into a savings account.
Right. If that's the case.
Yeah.
So all right, cool. Moving on, we have what to look for when you are looking into a stock. I feel like we kind of covered that when I asked you about what to look for in a business, but if you have anything else you want to add to that, answer that specifically, you can. What to look for when you're looking into a stock? You just want to look at things that I look at. I look at their beta. Their beta basically will show, how much the stock moves up and down compared to the overall market. I look at things like that. I try to balance that out as well. That's part of my diversification plan. If one stock, it'll be hard for me to explain right now without my chart, without a chart or something. So hold on. So when you're diversifying your portfolio, right, and you're choosing whatever amount of stocks or whatever amount of stocks you're gonna invest into, what you say is there such thing as diversification, over diversification?
Yeah.
At what point does it become over diversification? 10 stocks, 20 stocks, 3 stocks. What is the number? You know what I mean? In your opinion.
That's definitely a good question, because I know guys who's 30 stocks deep and they
in one portfolio.
And one portfolio, and they feel
because you can have multiple different portfolios.
Oh yeah. Oh yeah.
So for when if you're having a portfolio, for your portfolio personally, right? What's the max number of stocks you're gonna have in your portfolio before you said, all right, I'm gonna make another portfolio?
I go 5 to 10.
5 to 10. Okay.
I go 5 to 10, and I do have a few portfolios. My main one is technology. I focus on tech because that's just going to keep, that's what's going to keep the world going.
Right,
it's technology.
right.
It's
That's
technology in nature.
That's never gonna stop.
It's just never going to stop. So those are the things that I pay attention to. And damn, what was I getting to? Shit, what was the question again?
We was at I had asked you about at what point is over diversification, but before that we was on what to look for when you're looking into a stock.
Okay, yeah.
And you was talking about looking into the beta.
Yeah, so those are things that you have to pay attention to. I pay attention to the beta. I pay attention to the price to earners ratio, because like I said, that gives you an idea where its market value is. That's how.
So if I'm looking for that stuff, I could just search, blank company name, beta, blank company name, balance sheets, and all that shit will pop up.
I like Yahoo Finance. The thing is, you have to spend money to make money too, and that's in everything. It doesn't matter what you do. If you gotta hustle, you have to spend money to make money. Sometimes, So I have like premiums with Yahoo Finance where I get reports too from like expert analysis and things like that. I have like subscriptions to Wall Street Journal, and I read those every morning. And if like for you, the people who know me out there, if you pay attention to like my Facebook and stuff, like I share a lot of articles every morning. I try to do it every morning because it just gives you an idea of what's going on in the world. So try to get like a program like Yahoo Finance because it goes into detail about the stock. Like what is the company doing too? Like what type of innovation they got going on.
Okay.
The insiders sentiment and things like that. And you definitely want to pay attention to what the insiders are doing. That's another thing. Those are just key indicators, in my opinion. Everyone pays attention to different things, but I like to pay attention to like what goes on behind the curtains too, because that kind of directs the path of the stock price.
Okay. Now, so moving on to the next one, what is reoccurring investments?
Reoccurring investments is like when you just constantly have like a contribution coming in on a periodic on a periodic basis.
Mm-hmm.
Yeah. So let's say like every month on the 1st, I deposit a certain amount. I was going to say my amount by accident, but I just want to keep that.
Yeah.
So but I put in a certain amount every month. I have a certain game plan, and that's what it's called. It's called dollar cost averaging, and what it is you're minimizing your risk when you do that. So it's automation. That's another way to call it. Just think about it. Automation. You won't think about it. You set it. It's reoccurring every month. It's going to create something which you call compound interest. This is like a domino effect. So when you focus on automation, then comes compounding. Don't touch your investment. Let your interest earn, let your interest, times interest, just let it grow. And then, over time, you'll see the difference. And then, opposed to invest in January and then, March, you put in like a few dollars, and then you don't want to do that. Automate it. That's recurring investment.
All right. So, and then the next question is, how do you go about trading the stock, and what indicators do you look for? Like, okay, it's time to sell the stock. Okay, it's time to trade the stock.
See, now that goes back to when I was saying, it depends on what type of investor you are and what type of goals you have, because traders also have a certain point to where they want to sell. Now, again, I'm not a trader, but guys that I know, they set a certain market limit, and then they'll sell at that point because they believe, just looking at chart patterns and things like that. There's different chart patterns. That's a little bit more complicated.
So it all comes down to your plan. Really.
It just comes down to a plan. And when, trying to find a point into selling, just sell, like, a lot of time people sell stocks when they hear bad news too. Like, that's not a good time to sell stock. That's because
we was talking about that fear and emotion.
Yeah, the bad news pops up all the time. Tesla got bad news, multiple times in the media this year by itself, and they're still, doing phenomenal. I think, he just dropped to like the third richest guy in the world. I think today or yesterday or something like that. But, it all just depends on your plan. On like selling stocks and stuff like that.
So on to the next one. This is a question from another one from one of the Q&A we ran all week. What is compounding? You mentioned it earlier, but what is that?
It's interest times interest. It's basically your stock. Your investment makes money, and then it just the interest multiplies to that interest. It just grows. Warren Buffett wrote a book about it. It's called Snowball. I love this book. I think you put it on the last.
It might have been on the book list we created. If you guys go to our first episode we had, which was, I believe, it might have been episode 2. Might have been episode 2 or 3. One of the two. You'll see it. There's a book list in the description that he came up with. So that's what he's talking about there.
That book, the one you really should read is Money Master the Game by Tony Robbins, because it'll tell you why you shouldn't sell. When you see a little bit of profit, that's when you affect the compounding, really, because now your money's not making money. That's all it is. That's all compounding is. It's your money making money.
Okay, word. So on to the next one. We got mutual funds or stocks.
I like that question because now that's tricky. So mutual funds, right? Those are open-ended, professionally managed funds where they pool together different investors' money and buy certain securities. Now, this is the thing. A lot of these funds are not fiduciaries, okay? And like, a fiduciary is someone who puts their interest before, fiduciary is someone who puts the customer's interest before the company's.
Okay.
And by law, they're regulated. So, they give you the gold standard. Now, the opposite of the gold standard is a suitability standard. They'll give you a plan that's just suitable for you, but we don't want suitable.
Right.
You know what I mean? Suitable is average. Suitable is risky.
That's why we're all the fuck we are, because we motherfuckers want to be suitable.
Yeah, suitable is too average. It's risky as hell. And the thing about mutual funds is that they're protected by law. They do so. Let me give you an example. A 12B1 fee. Sometimes those fees are not on paper. They're hidden fees. And they're commissions. They're all types of fees. And it could come up to equaling 1% of, your investment. And that, like last episode, I said that could equal to about $300,000, $500,000 worth of your dollar gone over, whatever amount of time you've been investing. That's a lot of money. That's a lot. That messes up someone's nest eggs. I could use the extra $300,000 when I retire. I don't know about you, but I can.
Right. Right.
So, now individual stock picking is, you're managing your own portfolio. Now it's self-directed. You're more in control. You're not paying commissions. You're not paying fees, management fees, and things like that. You're basically saving more money. It's like owning your masters, pretty much, in like music or something like that. Like, you're just more in control. And there's different ways that you could do it. You could do a self-directed. There's 2 types of self-directed accounts. You have like something like Robinhood. You're picking your own stocks. But then you have things like American IRA. Check them out. because that's a fiduciary who, you know, allows you to hold investments they don't get paid for, like real estate. You could hold an actual tangible building in your portfolio, and they're never gonna really, these like Fidelities, they're not gonna tell us this because they don't make money off of it. Those are the big guys. Those are the sharks. So then you have these smaller guys, you know, they put in your interest before their companies, and they'll tell you like, oh, you can hold collectibles. There's certain things that are regulated, but you know, there's investments that's like normally not available for us that's actually available for us to hold in our self-directed IRAs, and it gets beautiful when you go into depth. There's like IRA LLCs. If you have an LLC, it's just different ways to, you know, to beat around.
You bringing up the Roth IRA kind of made me rewind in my head. In the beginning, we talked about trading and investing, and then you talked about how trading is not that tax savvy. So, in relations to a Roth IRA, which one is more tax savvy in relation to a Roth IRA? Trading, investing.
So basically, when you're investing, you're dealing with a Roth IRA or traditional IRA or SEP or 401k. Same with trading. You could do, there's trading platforms you could deal with the IRA.
Mm-hmm.
You mean, but you know, you're still going to end up paying like certain taxes because it's just like the amount that you sell. When you sell, you pay taxes. You get what I'm trying to say? So it's kind of hard to explain, but it's just better to, like, in my opinion, just to invest opposed to trading. Plus, you know, they lose a lot of money, and over time, like history shows, the trader just doesn't make as much as the investor would. You get what I'm trying to say?
Yeah.
Like, you know, it's a steady thing when you're invested. But
so that's the thing too. You said when you sell, you pay taxes on that.
Yeah. Well, when you take profit. Well, most traders take profit. So you get what I'm trying to say? Like, most traders take profit. They don't reinvest like. So,
for example, the IPO for Airbnb, when it was at $68,
dumped.
Let's say I went and bought 10 fucking shares of that, and then went and sold it when it hit 148. 3 hours later.
Capital gains, man.
Yeah. Okay.
Capital gains tax, and you want to hold investments over a year. You know, that's just to shorten the capital gains tax. You know, I'm not certified on taxes or anything, but that's just like a little knowledge that I know. You just want to hold your investment over a year.
Okay.
It shortens your capital gains tax. Speaking on capital gains tax, actually, if you had real estate and sold and you wanted to defer your taxes, you would actually invest that money into what you call opportunity zones. That's something that Donald Trump came up with. But the thing is, opportunity zones is like gentrification in some places, and it just makes the rich richer. Because if they hold their investment there, they end up not for like 10 years or something like that. They don't pay taxes at all. So,
right.
You know.
Yeah, because you don't pay taxes on something that's in the market.
You know.
It's when you pull it out.
It's when you pull it out.
Okay.
Yeah.
Okay.
It's when you pull it out.
So you can have $100,000 just sitting on in there.
Yeah.
And you never pay a dime in taxes on it.
Oh yeah, that's
as long as it's in there in the market.
Well, if you're doing after a certain amount of after 59 and a half, you could withdraw without being penalized something serious and being taxed something crazy. Just the Roth IRA is your contributions is tax deferred. Your gainings, your profits is unrealized profits is tax deferred. So that's like a double plus.
Right. Right. So we have a segment here. We put together the top 5 things somebody should know before jumping into the stock market, jumping into investing. Number 1 here is never jump blindly into any stock market.
Yeah, you definitely want to do your research on like the different exchanges. You want to do your research on like different like the companies that you're paying attention to, or you want to invest your dollar into. You never want to just put your money into something blindly because someone else is
Right,
talking
that's your
about
money.
it.
Fuck you.
Yeah, because it's like, like when I tell somebody about a stock, I'm just giving general advice. I mean, not advice. I'm just giving information. I'm just putting information out there. But I don't expect someone just to go buy the stock. Always do your own research.
Right, right.
Just pay attention to the little details and things like that. And don't take nobody's word for anything.
Word. Number 2, invest only your surplus funds.
Or yeah, pretty much.
Or only the money you can afford to invest in.
Yeah, because that it's like when Jay-Z said something about buying stuff. He said he's only going to buy something if he could afford it twice or 3 times or something like that.
Right.
That was in a old song or something.
Right. So it's like if you have $100 and that's all you have, don't invest $100.
Invest 50 or 25 or something like that. You don't. That's called over invested, and it's a thing. When I first started investing, I over invested plenty of times where I didn't even have money to travel.
Number 3 is we have avoid leverage.
Yeah, that's when you're dealing with leverage. It's pretty risky, especially like when you're first starting off. If you want to get your toes wet first, don't just stick away from leverage. That's more of like a professional trader type of thing. You could easily find yourself into a hole, dig yourself out of a hole, find yourself in debt. There was a kid actually on Robinhood who used leverage, woke up to like negative 700,000 or something like that, committed suicide. Turned out it was kind of a glitch, but he still used leverage when I don't think the kid even had a job, but that just goes to show that it's a risky thing to do. I never used leverage. I always use my own dollar. Leverage is basically borrowed money from a brokerage. It's just a risky thing to do when you're dealing with securities and things like that.
Of course.
Only time when I would really borrow money is when I'm doing like something with real estate, deal syndication or something like that. Other than that, stick away from leverage.
All right, and then number 4, diversify. Which you kind of covered, but diversify, but don't over diversify.
Yeah, so you want to have a plan, diversify, but stay like focused, so to speak. You want to keep your head straight and not like let your eyes wander, so to speak. So there's here's something that like I would recommend when it comes to like diversifying, or just let me pull up my notes here. So asset allocation is really important. You want to know where you're putting your money at and how much you're putting into a certain security. You also want to be in different industries, different sectors, and things like that. But just don't get too crazy with it. So something simple is something like 30. I have here. This is something that I use. 30% U.S. stocks, 40% long-term treasuries, 15% intermediate term treasuries, 7.5% like commodities, and 7.5% gold. Now that would create your entire portfolio. Now the gold, a lot of people don't think it generates a lot of profits, but see, the thing is, when the U.S. dollar drops, gold tends to go up. So they're not correlated. The U.S. market and gold is not correlated. And that's the thing. You want to deal with sectors that's not, correlated to each other.
Right.
And that's how you prevent yourself from losing money, but you also could partake in the market gain, by having 30% equity. You know what I mean? So that's a good way to diversify.
And number 5, which is the last one, for our top 5 things you must know before diving into any stock market is, which I feel like this one is huge, is don't let emotions impact your investment. Humans are emotional as fuck. Don't let your emotions impact your investment.
That's so true. And like fear is like one of the biggest, like, you know, ways to failure. You know what I mean?
And you mentioned it too. People see some bad news about a company, like fuck, sell, fuck, trade, whatever, right? And it's and that is
and it won't do
and then 3 days later it's like, you know what I mean? But then they sold it because of fear, because of I'm scared to lose this money. You know what I mean?
Now you missed out on opportunity.
Right.
You know, because you don't have your emotions in check. That's one thing that I had to really get.
But one thing that stops you from having or letting you're gonna have emotions no matter what. But one thing that stops you from letting your emotions take over is having that solid plan. You know what I mean? And then that discipline to stick to it.
Yeah.
You know what I mean? That's my plan. I'm gonna stick to it. My plan doesn't say trade here, or my plan doesn't say sell here.
Yeah.
So I'm not gonna fucking sell no matter how bad I think it looks to my emotion, to my brain. I'm not selling because my plan doesn't say to. I made this plan. I'm not gonna change my plan now. Like, all right, let's change it. You know, nah. When I first started this portfolio, the plan for this portfolio was X, Y, and Z. Yeah. So I'm not fucking selling, no matter what it looks like. Unless my plan hits those indicators, like, all right, boom, it's hit that one, it's hit that one, it's hit that one. All right, once it's hit all 3 indicators that I come up with, all right, it's time to sell. You know what I mean?
Yeah.
So
it's just going to create a solid habit. Yeah. It's just going to create a solid habit, too, you know? Just stick it to the game plan. Like, when you create a goal, too, most people, like, fail in their goals because they don't see any progress in, like, a week or something like that.
Right.
It's deeper than that, man. You got to stay the course. You know, when you stay persistent and things like that, it'll eventually work out, man. You got to, you know.
All right. So that being said, I know last time we mentioned we'll have Johnny the next time you're on. He's a tough guy to get to, but we're gonna have the motherfucker on here. I actually was talking to him yesterday. We're in the works of planning something, hopefully with us 3. Either way, Johnny will be on. You know, he's a different breed. We talked about him last time. He can attest that they have those conversations a lot.
Johnny's like a computer. Johnny's
that's a good way to put it.
Like he asks questions like you would only find like on this. I don't know. He's a computer. He's a robot. He's a smart guy. You know?
Yeah, and he's one of those dudes, bro. I feel like that motherfucker he just got like a log in his brain, and it's like a hard drive. Once it's in there, it doesn't go unless he decides for it to go. You know what I mean? Unless he chooses for that shit to go. That's
a blessing, because someone like me, I take notes. Yeah. I keep my notes. I reread my notes. Yeah. I'm like a fan of writing.
And I know he does take his notes and shit like that, but Johnny, as far as I know, like that dude takes his notes and then it's in there. It's locked in. You know what I mean? You know, but and that's why I think it was like I was talking to you. I'm like, nah, fuck that. Bring your notes on. You know what I mean? Because there's plenty of people that want to get into the stock market, right, and want to start investing, and they won't because the type of learner they think they are. You know what I mean? Oh, I can't do that stuff. I'll never be able. There's too much information. Yeah. I take your notes, and if you gotta fucking refer to your notes to answer a question, if you gotta refer to your notes or something, then you do it.
That's not a problem. That's not a problem. You know, because I do it all the time. I bring my notes to work. You know,
right.
So you know, when
sit down in the morning and look at the market, and you're looking at the market with your notes. You know what I mean? Yeah. That's just how it is. Some people learn like that. Some people, like Johnny, fucking have a hard drive in their brain and they can just store that shit.
He's a robot.
You know what I mean? Yeah,
he's
fucking
like a memory card.
100 gigs of RAM and shit in his brain. Like it's just crazy, but we are definitely gonna do a branch off segment where we go into depth. A lot of people are interested. I've got a lot of good feedback on the last episode. A lot of people are interested in learning more. A lot of people want to invest and don't know how to, don't know where to start. I think this episode we covered a lot of information. I think we covered a lot more information in this episode than we did in the last one. So that being said, we'll be back.
And before we go, there's definitely going to be a time where I'm gonna have an opportunity where people can invest alongside with me.
Word.
So I'm definitely looking forward to that time when it comes.
And your handle, Instagram, the Lucrative Investor.
The Lucrative Investor.
All right, cool. That being said, we're gonna wrap this shit up here. I appreciate you coming on, my brother.
Yes, sir. Appreciate you for having me.
Now let's roll a little blunt,
yes,
you know, and let's get down into the deep talks, the off-camera shit, the shit that
definitely.
We get into.
Yeah, man. The mastermind.
Yes, sir. Y'all be good, man. Peace.
Yep, stay safe.
Perfect.